Muted.
Hi everyone, welcome to our final quarterly call for 2016. We've muted all the phone lines and Peter O'Keefe and Justin Stevens have the microphone. This call is being recorded and will be available for replay by visiting stageready.com and by clicking on the O'Keefe and Stevens team page. Before we get started, we must remind you that the purpose of today's call is educational and that the material presented is publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call is available for replay on the Stage Ready website. Please contact us if you would like a link to the recording of this call or any previous calls.
All right, thanks, Carly. Thank you all for joining us on the call today. I hope everybody had a nice Thanksgiving. We received a lot of positive feedback on last quarter's call. I'm not sure if it was because Carly filled in for me and people enjoyed listening to her, or if we actually are getting better at these calls each time. Either way, we appreciate the feedback from those of you who provided it, and we will continue to strive to make these calls a productive use of your time. So today, we'll be spending a little extra time on the line at the end of the call to make sure anybody who has a question has time to think about those questions, and we'll give you some time to chime them in before we end the call. Similar to our last call, we're going to spend some time talking about a piece of our investment process to help increase your level of understanding on how we come to select our investments. Today's talk will be about the concept of risk, and specifically the risk we're trying to avoid and the risks most people consider that don't bother us so much. Next, we'll talk about the overall market. There's been a lot that's happened since the election, and as we step back and reflect, we thought it would be helpful to share our perspective on the media and also some perspective from Howard Marks, who we look up to as an esteemed value investor. And then, as always, we'll talk through a couple of our current investments. This time we're going to pay special attention to risk when covering our recent purchases in the different Sears investments and also with Sun Hung Kai Properties. Finally, we'll spend time once the recorded portion of the call has ended to answer any questions you might have. You can feel free to type those questions into the message box during our call, or if you're more comfortable just waiting till we mute the lines or unmute the lines, you can ask your question to us directly. And like I said earlier, we'll leave a little extra time so that if you have to think for a few moments, we'll still be here. So let's move into our first subject of the day, risk. So the reason we chose to talk about risk is because it's the most central concept to understand when it comes to value investing. In fact, I think this characteristic about value investors is what makes them unique. The many other methods of investing really do not take the approach of minimizing risk during the security selection process. You really have to ask yourself, what is risk? My experience has been you could ask any number of people for their definition of risk, and you're likely to find just as many varying answers. So I thought it'd be helpful to share what our definition and the risk that we're paying attention to is avoiding the permanent loss of your capital. You see, we have up here on the screen, risk does not equal volatility. So interestingly, that's how our industry typically analyzes risk. It's not that we prefer volatility, it's just that we don't hold it central in our analysis of an investment. So actually, to illustrate this, I'm going to borrow from somebody else. I'm going to read a little segment out of Warren Buffett's 1984 speech to the Columbia Business School, which is titled The Super Investors of Graham and Doddsville. As a side note here, if anybody would like a copy of that, I can email a link. It's a publicly available document. You can find it on Google. Really, it's a fantastic read. But Warren says, to read his example here, let's say you buy a dollar bill for 60 cents. It's riskier than if you buy a dollar bill for 40 cents, but the expectation of reward is greater in the later case. The greater the potential for reward in the value portfolio, the less risk there is. So one quick example. The Washington Post Company in 1973 was selling for $80 million in the market. At that time, that day, you could have sold the assets to any one of 10 buyers for not less than $400 million, and probably appreciably more. The company owned the Post, Newsweek, plus several television stations in major markets. Those same properties are worth $2 billion now. And remember, this was written in 1984. So the person who would have paid $400 million would not have been crazy. Now, if the stock had declined even further to a price that made the valuation $40 million instead of $80 million, its beta would have been greater. And to people who think beta measures risk, the cheaper price would have actually made it look riskier. This is truly Alice in Wonderland. I have never been able to figure out why it's riskier to buy $400 million worth of properties for $40 million than $80 million. And, as a matter of fact, if you buy such a group of such securities and you know anything at all about business valuation, there is essentially no risk in buying $400 million for $80 million, particularly if you do it by buying 10 $40 million piles for $8 million each. Since you don't have your hands on the $400 million, you want to be sure you are in with honest and reasonably competent people, but that's not a difficult job. You also have to have the knowledge to enable you to make a very general estimate about the value of the underlying businesses. But you don't cut it close. That is what Ben Graham meant by having a margin of safety. You don't try and buy businesses worth $83 million for $80 million. You leave yourself an enormous margin. When you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And that same principle works in investing. So we love Warren Buffett. We think he's great because he makes this complex seem so easy to understand. In our world, we're looking for investments where the margin of safety is great. The two investments we're going to cover today are prime examples of this. Both investments carry risk, but you'll see that in both cases we're buying the businesses for far less than their underlying asset values. We find this approach to be the most sensible way to protect permanent loss of capital. And it's a nice byproduct of that in the long run you can make a pretty good buck as others realize the supposed risks are actually just uncertainties. And again, volatility has nothing to do with this, especially when you're diversified amongst a group of securities, each with distinctly different risks.
Thanks, Justin. To get started on market comments, I wanted to share an excerpt from Howard Marks's latest memo, Go Figure, which was written a few days after the election. Howard says, so what happened? Well, first, Clinton didn't win, so there's much soul searching, particularly among those in the forecasting fraternity. Everyone knew intellectually that Trump had a non-zero chance of winning, but few people thought it could actually happen. And second, the U.S. stock market had its best week since 2014. The Dow Jones Industrials rose almost 5% for the week, taking them to new all-time highs. The Dow was up every day last week. It rose on Monday and Tuesday when Clinton was expected to win, and then it rose Wednesday, Thursday, and Friday after she had lost. That behavior calls to mind my January memo on the couch on the subject of the market's irrationality. Clearly, the election was the biggest event of the week, so it must have been the main influence behind the changes in stock market prices. But how could the election of an expectation of a Clinton victory make stock prices rise, and then the reality of her defeat make them rise further? Well, skip ahead. Two general observations can be made based on the election's developments. First, no one really knows what events are going to transpire. And second, no one knows what the market's reaction will be to those events. Those observations reinforce the belief that it's a mistake to base investment decisions based on macro forecasts. But I hope we already know that. We've had many talks individually about the media, and we've written about it in our newsletters. The election was a great reminder that the news is not always the real-world situation, and there can be a tremendous bias even from the most credible sources. There are good news resources, but just remember to keep your filter on and be looking for the facts, not opinions, to support your case. When investing, we do pay attention to the news, but it's not our guiding light. It's helpful to know that the current story surrounding your investments, but at the end of the day, it's our responsibility to understand the company and securities we're purchasing. The news can and will work against us, and we do our best to be aware of it. Justin?
All right. So on to Sears Holdings. We began purchasing Sears in July of this year after recognizing the common stock trades at a meaningful discount to the liquidation value of the company. Going back to what I discussed earlier about risk, the number one risk we're trying to avoid is permanent loss of your capital. In my Warren Buffett clip, a man by the name of Ben Graham was mentioned. Graham laid out the foundation for value investing and presented this concept of margin of safety. We become quite interested in this concept and went on to read Seth Klarman's book, Margin of Safety, which is a rare gem as it has been out of print for quite some time. But in this book, Klarman identifies 3 ways to buy at a discount from underlying value. The first way is you can analyze the business as an ongoing concern, which is also known as the net present value analysis. When you do this, you take the approach of discounting all the future cash flows that the business is expected to generate, and you discount them back to present day values. So you take expected earnings for out 10 years, and each year that you go out farther, you have applying a bigger discount to those earnings to arrive at a present value for today. The second is stock market value, which estimates the price at which a company or its subsidiaries could separately, or considered separately, would trade in the market. This is a less reliable way to value a company, yet it's still a commonly used approach. And then third is a business valuation analyzing the liquidation value, which values the company should the assets be dismantled and sold off. So in the case of Sears Holdings, we have an excellent example of liquidation value. Before I go through this chart on the screen, let me first explain what we see as being wrong with this company. For starters, Sears is burning through their cash, which does not build confidence or trust amongst any of the company's constituents. I read an article a couple of weeks ago about many suppliers to department stores greatly decreasing the amount of supplied inventory leading up to the holiday shopping season. Because of this cash burn, the analyst community, which typically focuses on the income statement of businesses, has written off this security entirely. In the last 10 years, the stock has dropped from a high price of $177 per share to a low of $10 per share. Currently, the company trades at about $12 to $13 per share. This shareholder flee has placed quite a strain on the management of the company, and it's taking longer than expected to monetize the enormous asset base of the company. Every month that goes by means massive outflows of cash from operations. So let me talk through what we see on the screen here to explain our positioning. The credit to this chart above goes to Bruce Berkowitz's team at the Fairholme Funds in Miami. This buildup provides us with a detailed view of the value of the assets of Sears Holdings. Sears is unlike any other department store in that they own their own properties. This strategy was implemented back when suburban malls were first being developed. Sears was an anchor tenant and actually helped developers by securing the financing for the properties by agreeing to partner with them. That meant Sears had first choice to the location of their stores as well. So you'll notice the next time you're at a mall that most of the Sears stores are near the main entrance to the mall and have multiple exterior entrances to their building. Additionally, because they own this property, they pay very little rents to occupy their square footage. The real estate holds a substantial value in this investment. Sears actually owned more retail square footage than some of the largest real estate investment trusts that dominate the mall space. Conservative estimates of this value of the real estate are over $15 billion. That would translate to $123 per share. Keep in mind that the stock trades for under $13 per share today. Next, the company owns some valuable assets that are saleable or could be spun off into their own publicly traded companies. This happened with Land's End in 2014. As individual companies, we feel Kenmore Appliances, Craftsman Tools, Diehard Batteries, and Sears Home Services are all individually successful businesses that could reasonably be valued at over $1 billion each. This adds another $40 per share of value to the liquidation buildup. And if you go down the list of assets, it's clear that the assets far outweigh Sears' liabilities. Berkowitz and his team come up with a per share net asset value of $147 per share, which is in great excess of the $13 per share trading price. Now, whether or not these numbers are exact is not what's in question. The idea behind margin of safety is to provide enough of a buffer to be wrong, yet still be safe. When you buy something that you feel is worth $150 for $15, even if it only turns out to sell for $50, you still profited handsomely. That's exactly the situation we feel we have with Sears. So as I mentioned on the last slide, we've purchased Sears Holdings, the common stock of the company. Additionally, we've been buying Seritage Growth Properties, which was another spin-off of Sears in 2015. This real estate investment trust owns 255 pieces of Sears real estate and is working on the transformation of those properties from Sears stores to a more diverse tenant base. Sears pays a very low rent, approximately $4 per square foot, to occupy these spaces. By moving Sears stores into smaller space and recharacterizing the properties, Seritage is able to raise the rents to $17 to $20 per square foot. We also recently began analyzing Sears Canada, which is a much smaller organization than its U.S. counterpart. Nevertheless, the value gap appears just as wide. The price of Sears Canada ranges from a high of $8.47 this year to a low of $1.55. Currently, it trades much closer to the low end of this range. While these three companies at first may seem to carry a tremendous amount of risk, the uncertainty has created an opportunity to buy the assets of each business for far less than they're worth. Furthermore, we feel we are getting into an investment that is managed by incredibly capable and like-minded people. The CEO of the company, Eddie Lampert, owns over 50% of the company. Next in line is Bruce Berkowitz, who owns 25% and is on the board of the directors for Sears Holdings. Both of these men have a terrific track record of managing value investments and have written extensively about these companies. So Peter and I have been able to familiarize ourselves with the businesses, and we have a good idea of how they intend to run these companies. The situation appears to have a very low risk of permanent loss of capital. Given the value of the assets and a likelihood that the return to investors will exceed their cost, the true price is likely to be paid in the patience of waiting for this uncertainty to pass.
Thank you, Justin. Let's talk about Sung Hung Thai Properties. We began purchasing this company at the end of June 2016, and as you can see on the screen, the company owns high-profile real estate and is focused on some of the dominant markets in China, Hong Kong, and Shanghai. We were alerted to this investment through like-minded investment managers. Investors fear that the Chinese economy is facing a serious downturn and have been reallocating their investments to other parts of the globe. This macro trend, coupled with an incident in 2012 where two of the company's officers were arrested and accused of bribery, Unfortunately, this issue has been resolved and they're no longer a threat to the business. Meanwhile, the shares of the company trade at a significant discount to the value of the underlying assets. Similar to the case in Sears, we have a situation where incredibly valuable real estate is trading at far less than its liquidating value. The properties that the business owns are, without question, incredibly valuable. They own buildings in high rent districts in these two major cities, and the demand for space is stable, and the occupancy is high, and the rents are steady and rising. Currently, the company pays a 45-cent dividend, which equates to about a 3.5% yield. The ownership of these businesses is another strength in our eyes. The Kwok family is a prominent family in the construction industry of China and owns approximately 40% of the stock. Our understanding is that the China government has shown preferential treatment to Chinese owners of businesses. In this instance, it's better to be with the company that is controlled by Chinese rather than outsiders. The company has grown to manage a $30 billion portfolio of real estate assets. They have over $20 billion in development projects and hold significant land for future development. Whether or not future developments occur is not what will drive the returns on this investment, in our opinion. The company has the ability to generate significant cash flows and has been diligent in returning those profits to shareholders in the forms of dividends and investments back into the business. If future investments were to slow down or halt, we think the dividend could rise substantially, and that could lead to a further increase in the price of the equity. Going back to Justin's comments on a margin of safety, the investment in Sung Hong Kai is another opportunity to buy high-quality assets for far less than they're worth and collect a nice income while we wait for the market to realize the difference between the stock's current price and the underlying value of the properties they own. Justin?
With that, we're going to wrap up the recorded portion of this call. Carly will unmute the lines for our question and answer session. Thank you for tuning into the O'Keefe and Stevens team's final quarterly call for 2016. This concludes the November 30th, 2016 O'Keefe and Stevens quarterly update call. This call is going to be archived on our new Sage Ready team webpage and can be requested by emailing any of the members of our team.